For that, we've got Parag Thakkar from Fort Capital joining us on the show. Many of you would recognize him as the face behind ICICI Pru and some of their funds. Parag, thank you very much for joining in. So first, let's straight away get to the GDP print, right? Okay. It came in as a bit of a shocker, but markets appear to be taking it in the stride now. We're back in the green.
Yeah, because actually everyone who has spoken to the companies during this period of last quarter and who has seen the numbers, he will not be shocked with this number.
It was bad
because it was really bad. You know, where have you seen the paint companies and FMCG companies showing negative growth? You know, so all this, and I think it's a self-applied break by our government. Election, heat wave, monsoon, and of course RBI tightening on so many fronts, like MFI stress, and rightly so. So I think all this has come together. So when Nifty was at 26,000, we raised a lot of cash. Even today, we are sitting on 10 to 15% cash level across the portfolios, because we felt that market was running ahead of itself at 26,000 Nifty, because September quarter's results were going to be bad. But now from here on, I would say that this is a bottom. Because, for example, festive season demand has picked up a bit. We have a longest marriage season, November to Jan, which will boost consumption to some extent, and government spending will also pick up by March. So I would say that in April we should be talking a different story. So this is a good time to deploy money on every dips. Plus, I would say that on Friday in RBI meeting, definitely we'll see some sort of liquidity infusion, which is durable liquidity, which will stabilize the market.
It'll be very important, the RBI commentary as well, right? After these numbers. And as you said, now the demand is looking up, and whatever was done in quarter two in terms of weak earnings, so the first half, that is something that was self-applied break, so to say. But going forward, Parag, what are some of the picks? If you are saying 10 to 15% cash, but now cash should be deployed on every dip. You like HUL. It's the consumption name, the consumption theme didn't do so well. What are you liking here, and versus other peers? How do you like it?
I'll tell you, first of all, Unilever growth officer coming in India and saying that India is their heartbeat. That gives me a great comfort that their focus is on India. Of course, 11% of their revenues comes from India. The other thing is they have underperformed so much since last 4 or 5 years. If you see, after that block happened of 25,000 crores. And plus, they are saying in their capital market, they have said they are aspiring for double-digit EPS growth based on led by revenue, led by top line and volumes. So, and plus they have huge opportunity to grow and upscale and premiumize the beauty and wellness category, right? Because in India, the premiumization is a core play, right? And Lever is a good play in beauty and wellness segment. And plus, I think, multiple wise also historically it has traded 50 to 55x. Today it is trading at 40 times FY27 earnings of 60 rupees. So we would say that 25% upside looks great. First of all, disclaimer that we own that in our portfolio. And apart from Lever, for example, Larsen. Now, Larsen is also a large part of our holding. We have seen government spending lagging, right? That is the core reason behind this GDP thing. Now, government spending has to come back. So you have to, at the bottom of the cycle, Larsen or cement stocks, for example, today cement stocks are looking up, right? Because we have hit the bottom there. Same way for ICICI and SBI, I'll cover it. These are the banks which have comfortable CD ratios, strong deposit franchises, stable asset quality. Credit cost is 50 bips only for both of them. ICICI is a steady compounder with 15% growth. And SBI has also set at 14 to 16% growth. SBI's last year's, if you see FY24 standalone PAT was 61,000 crore. The chairman has said on media saying that 3 to 5 years, this PAT will double to 1 lakh crores. From 61,000 crore to 1 lakh crore. So it is 12 to 13% EPS CAGR in a large cap company like SBI, which is trading at only 7 PE on FY27 and price to book is just 1.1x on FY26. While actually they are doing a ROI of 1.2 and ROE of 16 to 18%. So they should get 1.3, 1.4x in my view. So in the next 18 to 24 months, you can see 25% upside over there also.
HDFC Bank was the darling of investors, right?
Absolutely.
But you're saying SBI and ICICI Bank would be preferred.
No, I'm a big believer of HDFC Bank's DNA. I have gone on public many times saying that this is a temporary problem. The only thing is that because they have to bring down the growth load because of the CD ratio issue. Of course, they have brought down CD ratio from 110% to 100% very nicely, quickly and rightly so. And they are going to bring it down in another 6 to 7 quarters. You will see them at 90% in terms of CD ratio.
But you think till then, for the next 1.5 to 2 years, HDFC's bank banks' growth will be slower than peers.
Growth will be slower, but
so
I think
therefore-
that is known to market, and their asset quality is pristine. There is no problem in their asset quality at all, right? So the only thing which I would monitor in HDFC Bank is margins, because when you bring down your growth so much. And of course, you are not lending to riskier segments, right?
Right.
That is where SBI has a very high liberty, because SBI's CD ratio is only 69%.
And it has been outperforming.
So if suppose private sector capex picks up, if government capex picks up, SBI is there to lend.
Help, yeah.
They also have a 6 lakh crore pipeline, right, in corporates to lend to. So because of their lower CD ratio, they can participate in that capex cycle led by government as well as private sector if it comes back.
And that's the hope, right? In the second half, at least, the government capex cycle, that would improve versus first half. And if there's private capex as well, it could prove positive for SBI. Parag, a pleasure speaking with you today. Thank you so much for joining in and telling us what all you like in the markets. And yes, maybe it could be the bottom and we could look up from here. So that's the market and fundamental conversation. But it's time for a short break. When we come back, we'll talk more on the markets on the other side and a lot of stock-specific action as well. Stay tuned.